Good evening and a warm welcome to everybody. I am Angelica Kinney, your host for the webinar today, and let's dive straight into it. Today's webinar is all about SIPs versus lump sum and what's the right way to start your investment journey. And to understand this better, it is my pleasure to introduce Sir Rishab Lunia. Rishab Lunia is a co-founder of Knowise and has been working in the financial services industry for more than 19 years. He has worked with more than 2 lakh professionals to equip them with skill set and knowledge required in their professional journey. Sir is an accredited trainer and with NiSM, an entity of SEBI. Sir brings expertise and practical insights to the table with a wealth of knowledge and expertise to our webinar. Before moving ahead with the session, please know that if you have any questions for the webinar, to send them in the comment box and we would take those up towards the end of the session. Sir, over to you.
Thanks, Angelica, for having me here for this lovely topic. I think this is the need of the hour, and everybody is in the constant, I would say, fight to find out what's best for them. So today, let's have some answers for our audience, what's best for them, and let's quickly get into the webinar. Can we have the slides? Yeah, thank you so much. So I think Indian markets have seen a great amount of bull run for last few years, and today, as we speak, uh, there is a doubt in the investor's mind whether to go for a systematic investment plan or to go for lump sum. And next few, let's say, minutes, will dwell into a lot of learning which will help our audience to take a decision on their behalf, that what makes sense for their portfolio. So without wasting time, let's understand the scenario. Now, I think all of us as cricket enthusiasts are looking forward to this contest coming Sunday, where the two great teams will try to put their hand on that coveted trophy. So we don't want to miss this contest. But the contest here, what we want to speak today, is between the SIP and the lump sum. Now, I'm sure there are no doubts in our investor mind that these two are great investment ways through which they can start their investing journey. And I'm sure that some of you have already benefited from either of these two. But let's dive more and understand each of them in a more simplified way, with the current market condition, with the volatility around, what makes sense for our portfolio and which is equipped enough to fulfill our financial goals in the long term. So that would be the discussion point for today's webinar, and I'm sure you're going to make some notes from today's program. Now, let's first get into the lump sum investment, what it is, how it is done, who should look at it, and what it brings to the table. Now, if you go and read any investment objective and details of most of the mutual fund products, you will see that most of them have made a lump sum of 5,000 rupees with an additional investment of 1,000 or 1 rupee, whatever may be that product. So you can start your lump sum journey with as low as 5,000, and depending on how much is your financial goal, you can top it up. There's no limit on the upside. Um, but when it comes to the time horizon, when it comes to finding out, okay, which goal should I prioritize with lump sum, there comes a little bit of skill which, as investor, you're supposed to have. Now, we may have different types of financial goals. Some are short term, some are medium terms, and some are long term. Typically, when you're looking at lump sum investment, and that too if it is a equity fund which you are putting your lump sum in, generally we say that it is meant for your long term financial goals. But at the same time, if you want to do a lump sum, but for a shorter period, you can do it, which can go, let's say, in a liquid fund or a short term debt fund, which is meant for your short term goal. So it's purely on the time horizon, and time horizon depends purely on which financial goal you are targeting for yourself. Having said that, Here we are talking about, let's say, equity markets, and equity markets are known to be volatile in short term. But we also know that short term plus short term plus short term makes long term. So if you want to make wealth creation for yourself in long term, you need to make right choices in short term as well. So when you are looking to use lump sum investment in shorter term, you need to make sure that you're covering your volatility, or you are knowing that your money which you are investing can tend to be more volatile in the short term. So once you have time horizon, volatility, financial goal, once you have this understanding, you are ready to take. Let's start your investing journey with a lump sum investment. Now, do lump sum investment have any challenges? Do we have to be more careful when we are putting our money, especially a little larger chunk? So normally when people get their bonuses, when people, let's say, have sold their property and they're sitting with a huge chunk of money and they are planning to put that kind of money, that is when the real fear sets in into the mind. Is this the right time to put this kind of money? So what are the challenges which we can have when we are looking to take those decisions for putting that larger chunk of lump sum money into the markets? So for that, we need to understand. Let's share some data for you that how lump sum investment have yielded returns in the past. So here there is a Grow Value Fund. Okay, and this is a January fact sheet. So if you see a 1 year, 3 year, 5 year performance vis-a-vis compared to the benchmark and additional benchmark, you will see the performance of a fund. Now here, as you are aware, SEBI has asked all the mutual fund companies to show their performance both in terms of value as well as a percentage CAGR return for various tenure. So here we can see 1 year, 3 year, 5 year, and since inception performance of a value fund. Now, there is a word here which shows which reads like TRI. So benchmark, which is, let's say, Nifty 500 TRI. So it is total return index. Uh, Earlier, people were using PRI, which is price return index, but now we have moved to a total return index, which has to be used as a benchmark. So now, what are the challenges as investor you and me can face when we are planning to look for lump sum investment? And the biggest of that is my timing right, or should I wait to put my lump sum? So everybody is very skeptical when they're putting that large chunk about the timing of the market. How do we know exactly whether this is the right time or not? So we did one, let's say, a small test in terms of somebody who's been investing for last 15 years into the market, and they did their lump sum, and how two different investors had two different journeys, even if they had invested very close to each other. So just presenting to you a little data on a, let's say, a long-term investing, which was done in the year 2007, before the great financial crisis, which we saw in 2008, and somebody who had just invested post that crash. So if you look at, and the data taken here is the Sensex data. So somebody who had done, let's say, a index investing when the index was at 20,000 level, and we have taken the current value till yesterday, they would have made a CAGR return of about 13.39% in the Sensex. So over last, if I can say, the journey has been from the year 2007 to 2025 February. Now, the second gentleman had invested a little, let's say 8 months, 10 months down the line, and the return, if you see, is hardly 7.91%. Now, both of them have invested almost for about, let's say, about 17, 18 odd years. They've given their time to the market. But one has generated a decent return of about 13, 14%, while other have just made half of that. Now, what made this static difference is their timing when they entered. So somebody who had entered at the, let's say, at the top had made a little return, and vice versa for the other person. Now, the other challenge which the people may have in investing is their behavior biases may take over their financial goals. Now, all of us, if you look at, are having a lot of behavioral biases when we take day-to-day decision on investing. And if we know these biases, we will be taking our decision more logically, more with a lot of intellect. So, what are these behavioral biases? First, we need to understand them, and then we need to find out ways in which we have solution to these biases. So some of the common biases which I think all of us should know, so that we can avoid making those silly mistakes what the other person did with his investment in 2007. And one common bias which I see a lot of investors making is the anchoring bias. Now, what is anchoring bias? Let me give you my personal experience. One of my relative who is also a long-term investor in the market, he keeps on asking me, please suggest some good scripts, or please recommend some scripts. Even after telling him that I am part of the industry and we are not allowed to recommend, uh, over the years, this gentleman has become smart, and he asked the same question in a different manner. He says, what is your last investment? And I share the name of the company, and without telling me, he goes and invests in that company. Okay. Now, when I last met up with him, when I shared some name of the company, I told him that this is my investment and there is a lot of risk in equity markets. All the disclaimers given, but without telling me, he goes and invests. And after 6 months, when we meet again, this gentleman is quite very happy because that investment have given him good return, because during that time the stock did pretty well. And he asked me, are you still holding the stock? I said, yes, I'm still holding the stock. Then the person is like, okay. Then we third time when we meet, this gentleman is not looking all that great, and I couldn't stop myself asking, how's your portfolio doing now? Because I now know that he's also holding the same script. And this time this gentleman is not all that excited, and like, I actually didn't tell you, but I have sold the stock the last time when we met. After our discussion, I came out. I said, good for you. But if you want the story is intact and the long term looks good, people, the management is good and the story all around is good. But from that day till date, the stock has gone and made a lot of return, but that gentleman could never enter the stock. The only reason was, when we sell a stock at a certain level, and when we are trying to re-enter at a level which is higher than the level at which we sold, our mind many a times never allow us to take that decision, because it always anchor it at with the first price, which is the price at which we sold the stock. And it happens all the time. I have seen people who, at the time of buying stock, let's say stock is at 400 rupees, they will put a buying price at 395, and they said, I will buy this stock if it touch 395. Now, what's the logic? I don't know, but they have the sentiment that, okay, I want to pick this stock at this price. And we see that many a time it doesn't touch 395 and it reverses from 396, and that person has missed probably a potential good stock just because of 1 rupee. So these biases, if you are having, it's very important that you take note of them and take decision after knowing it. If you are good and bullish about a particular, let's say, a mutual fund or a stock, I think the price is the last thing which you should look at. You should look at a lot of other things, not the price. Same thing happens with herd mentality. Now, many a time what you see is some report breaks and markets actually puts down that stock, or a positive news come and the people are gaga about that stock. Without reading that report, many a time we also join the bandwagon and we start buying and selling the stock, which is again not right at our part. So if something is happening in the larger context of the market, it's okay to be part of it, but after taking logical decision with your portfolio in mind. And at times, especially this, I think a lot of you will associate with this bias, is called overconfidence bias. And generally, these things happen when markets are doing pretty great. There is a saying that when markets are doing good, everybody feel that they are fund managers, and that is nothing but because of the overconfidence bias which you can get at that time, because things are going in the right direction. 9 out of 10 decisions which you take towards your portfolio are going in the favor, which can lead you to this bias. Now, even if you are pretty confident on the decision which you're going to take, run it through some numbers, run it through some data point, checkpoint, to make sure that you are covered from all these sides. And the last one is our confirmation bias. Now, confirmation bias is a bias which you and me take on a daily basis when we take and make those small decisions to buy anything. Let's say you want to pick a mobile phone. Now, already in your mind, you might have some model which you want to put your hands on. But before uh, doing that transaction, you just want to run that decision with your inner circle. And you just go to some of your friends, your close friends, your relatives. Some of them validate your idea and say it's a great purchase. And other people may say that, okay, why do you want to spend so much? Take another option which is more economical and will serve the purpose. But because you've already made your mind will always go with the decision of all those people who confirms and validates your decision, and you will take that as a yes, and you will go ahead and make the purchases. So same thing happens with our investing journey also. Suppose you want to pick a mutual fund in your portfolio, and you are sitting and looking at the, let's say, business news, and one of the speaker is talking positive about the same mutual fund. Without changing the channel, you can go and listen to that person for hours together. But if another gentleman comes and he says a little bit negative about that particular fund, you may switch the channel or you may switch off the TV. So the mind is pretty simple in that way. It tries to resonate with all the ideas which it has. And that's a bias when we take certain decisions. So once you take control of all these biases, I think you as an investor become more prudent, more informed, and more logical in your decision making choices. Now, coming to the second product, which is the systematic investment plan, which needs no introduction. I think one of the best invention in the mutual fund industry, become a household name. I think since the beginning of my career, I have seen different phases of SIP. Early 2000, where I've seen this product, where mutual fund used to push this product because they knew that how good this product is and how it should be part of everybody's life. But at that time, the concept of mutual fund was relatively new in India, and at that time, I have seen it being pushed. But today, it's like a pull where every family is asking this question: okay, which SIP to invest, for how long to invest, rather than whether we should invest or not. So that question is out of context. It is more informed decision which investors are taking today. So in a simple way, it's a very, very simple plan for all those people who don't want to be in constant touch with the markets, but still want to benefit from the market in the long run. Can be part by using a systematic investment plan. Now, what happens in SIP is, because you are constantly transacting month on month, you are not worried about where the market is heading. The whole idea is to keep buying at a systematic manner, so that in long run you are trying to average your pricing. So rupee cost averaging, which is the main feature of SIP, makes this very attractive for long term investors, because you average your pricing in long term, and when markets go high and high in long term, you create value for yourself and for your portfolio. So it's an excellent tool for somebody looking to create wealth in a longer run, and in a much, I would say, risk adjusted manner. why I'm saying risk adjusted manner, because you're not taking too much of risk, because your quantum of uh, let's say the token which you're putting to investment is comparatively less when compared to a lump sum investment which you make. So you are putting a smaller bet on markets, but the idea here, it's the regular interval which does the magic. And as I said, it's quite effortless. Once you start it, you don't have to monitor it regularly. Fund managers are doing their bit of story. You don't have to time. The whole idea of SIP is you don't want to time the market. So the great Warren Buffett said that it's not the time in the market, timing the market, which is important, but your time in it is more relevant for long-term investing. And SIP makes sure that you get that enough timing which you are putting into the market for the long run. Now, Grow has a aggressive hybrid fund, and here's the SIP performance. So, like we showed you the lump sum performance, here is the SIP performance over various tenures. So, 1 year, 3 year, 5 years, and since inception, how the fund has fared versus its benchmark and versus its additional benchmark. Now, it's an aggressive hybrid fund. So, hybrid fund is a combination of debt and equity. Aggressive hybrid states that you have more of equity component in this than the debt component. So if you look at the benchmark here, it's the CRISIL hybrid 3565 aggressive index, and the additional benchmark would be your Nifty 50 TRI. So this is the performance. This is how you look at. Now the next big question is, after understanding a lump sum, after understanding a SIP, what should be the right approach for me as an investor? Now, I'm sure all of us have witnessed that historical performance of Virat Kohli in the previous match. Now, any kid who's growing up and who wants to be a cricketer, his dream is quite simple, that I want to be part of the Indian cricket team, and I want to, let's say, hit and make centuries. Uh, Idea of any person who's coming and, let's say, uh, playing for India is to win matches for India and to make a lot of runs. But you need to be practical that all the matches you can't go out there and make four and sixes, though everybody would want to do that. But what we saw in the previous match, where Virat came out and played that logical inning where hardly he had scored any boundaries, hardly, I think, 4 or 5 boundaries in the complete inning. And it was pure those singles and doubles which constructed the inning. So lump sum and SIP is exactly like that. Okay, so let's explore a little bit. So SIP is like a Chinese bamboo. I'm not sure whether you've heard this. So China, in China, we have this tree called Chinese bamboo tree, which takes a lot of time to show any kind of development. So if you put the seed today, for first 3 4 years, you will hardly see any growth, and from the fifth year, it grows like a bamboo tree in no time. So many a time you might see your SIP performance like that. For first few years, you may not see any visible change in your portfolio value. It may be very close to what you've put, or slightly high or slightly low. But when you get into a little bit of time, then the SIP starts unfolding its potential, and in long run, you visibly make the difference what it can bring to the table. Now, there are some instances which we have shown of a different period, where for a 3 year, 4 year period, market had remained flat, NAVs have not moved, but one good year has a power to give you compensation for the 3 or 4 years of lull phases which you may have in your period. Now, if you see here, we have taken an instance of 1995. Markets were pretty down. It had come down in 97, and then a slow pick up till 99. So from 95 to 99, hardly any kind of return which investors would have made. But what they have done is they have kept on accumulating units during that time. and that accumulation would have given returns when the markets went up in 2000. Similarly, another time period, 2010 to 2014. Okay, again, markets saw some short-term volatility during this period, but again, not a great time where markets have given very return. But again, reiterating, this was the phase where a lot of SIP investors accumulated units, and today they thank this period because in long run they had seen a decent return on their portfolio because of the number of units which you accumulate during such phases. Now, so before we move forward, let me try to show you a little bit of yeah. I hope this is visible, Angelica, the Excel. Yes. Yeah. All right. So this is a small example of a SIP which we would like to show to all of you. Uh, Now, this is a index investing case where people have invested in a BSE 500, which is your multi-cap index, which have large cap, mid cap, and small cap. Somebody who did a SIP in the year 99. Now, if you ask anyone that somebody who's doing a large cap, let's say a lump sum investment in any index during this time period and staying till today for, let's say, next 25, 27 year, undoubtedly you will get your answers that lump sum would have done much, much better when compared to SIP. So let's do a small test to understand during this long-term phase of about 25 odd years, how the lump sum have fared, how SIP have fared, so that we can make a logical conclusion in terms of what is good for us. So here, first of all, I am showing you a SIP of 10,000 rupees done on the index in the month of February 1999, where we start, and then we do this on a month-on-month basis. So if you look at the value at the beginning was 1015.7, so we have assumed a NAV of 10.16, and let's say it gives you 984.54 unit to start with, and then every month you're putting the same amount. So it's a case of regular SIP which you've been doing for almost 27 odd years. If you take the value of this 10,000 which you are putting from your pocket, it will give you that you had invested close to 31 lakh rupees, 31 lakh 10,000 rupees to be precise, from February 1999 till date. Now, if you take the value, if you take all the consolidated units, it gives you 81,518 units, which gives you a current value of 2.99 crores. So approximately 3 odd crores, which you have made by investing 31 lakhs. But now, mind you, you have not put this 31 lakhs in one shot. You have put it in a small tranches of 10,000 month on month. And you, if you find the difference, about 90% of value which you have created has come from market appreciation, okay, or market or capital gains, what we call it. The CAGR return in this investment is working out to close to 14%, so 13.86% to be pretty precise. Now, if somebody had put this amount, okay, in the fund on day one, if somebody had to do a lump sum of this amount in February 99, how much would have been the value today? Any guesses? I'm sure you might think it will be lot more than what you made in SIP, and your guess is right. The value of this corpus in a lump sum investment would be roughly about 11.2 odd crores. which is almost, let's say, close to 3 times more than what you have made than SIP. But if you find the CAGR, that means the annualized growth rate, it is just a percentage difference from what you have made in SIP. So CAGR is not all that great, because why CAGR is relatively less, but the value is very high? Because of your initial corpus value, where you started a SIP with just 10,000, but you're starting a lump sum with a value of 31 lakh 10,000 rupees. Now, so this gives you a fair understanding of how much to expect in long term and how you can create your journey with a lump sum and SIP. Mm, So if you look at the crux here is all those people who are sitting with that kind of money, okay, a big chunk of money, it's for them to decide, okay, whether it makes sense in their portfolio or not. Somebody who is having a dependence on the salary or getting a smaller chunk month on month, undoubtedly SIP makes clear sense. So to make a choice, lump sum in terms of corpus value clearly wins the race here, but SIP with the kind of amount which you start with is more practical in its sense. Now, coming back and asking another question, that what if I want to put a lump sum, but I am not sure whether it is the right time for me to put in that kind of money? So, in that case, we did another experiment here, and we did the same test, okay, same BSE 500, and put to use again the great financial crisis. Okay, if you look at somebody who had invested before the peak and somebody who had invested after the fall, how the value of 1 lakh investment has changed over the years. So if you look at somebody who had invested 1 lakh in December 2000, okay, how much they would have made. The second scenario we have taken, if somebody who had invested just after the crash when the market had bottomed, okay, and we have taken another scenario where we are saying you're doing a systematic transaction for, let's say, 20 months when the fall was happening. Now it's easier today to look back and say that, okay, that was the big peak and that was the bottom. But when it is happening, it's very, very difficult for us to take that decision whether the market has bottomed out or there is still some fall which the markets can take, and at that time what is more logical. So in that scenario we always have this option with us to use these two great options for our investing. We take the power of lump sum, we take the benefits of systematic investment, and we club these two to make a case for ourselves. So let's see what this particular experiment has given us. This 1 lakh rupee which we had invested before the fall of 2007 has given us in December 2024 about 4 lakh 27 odd thousand rupees. That means we have made about 4.2527 times the return if we had invested at the market. Okay. If the same amount had invested at the fall, which is okay, it will work out to 11 lakhs 14,223. That means after market crash, if somebody had invested, they would have seen 11 times their money in next, let's say, about 16 odd years. And the case which we are presenting here, what if somebody had done, if they had not put that 1 lakh in one tranche and they have broken down into small tranches of 5,000 each and entered the market in next 20 months, how would that will do when compared to the other two options? So we say that obviously we know that somebody who had made 11,000, it will not fetch you 11,000, but it has not done as bad as the first option either. So if you look here, somebody who has done a STP from December 2007 for next 20 months, okay, they have accumulated about 2,000 odd units, and made a value of 7,58,000, which in turns work out to a portfolio return of 13.30, which is not as low as 8.92, is not as high as 16.26, but gives you a fair experience of the market in the. So when you use a product like a systematic investment clubbed with a lump sum investment, I think you make a perfect case for yourself for long term investing. So let's go back to the presentation, and so whenever you come across, let's say, a highway where you have to exit, let's say, obviously you will not decide at the fag end when to move left. You will plan your exit. So let's say if you're going at 100, kilometers per hour, you will slow down to 100, 80, 60, 40, and then you take that exit. So similarly, when you are coming out from your investment very closer to your financial goals, don't take out all your money in one shot like a lump sum takeaway, but you can plan your exit also. So systematic investment, though we talk more about SIPs all the time, but systematic withdrawal and systematic transfer plan are equally important in some our journey, because they give you that advantage of averaging even when you are coming out. So timing the market is a risk which we can take while at the entering, also at the time of exit. So when you move away from it and make your investments systematic both at the time of investing and while coming out, you reduce yourself the risk of timing the market and getting in benefit the averaging price which you can get because of those averaging. So STP is quite simple. You use a conservative product where you put in all the funds if you are investing, and then transfer it to a mutual fund month on month. Now the tenure can be dependent on your financial goals, depending on your investment amount, depending on your view on the market. So a lot of things decide what will be the tenure, but don't make it too small, don't make it too big. Take a decision based on your financial goals. So while entering, using a conservative plan to put in all the funds and then transferring it to, let's say, a slightly risky product, versus when you're coming out, it's the other way around. Suppose you want to come out from an equity fund, you are moving the other way around. So you're taking out the money from equity portfolio and transferring it to a short-term debt product or a liquid fund, depending on your risk appetite. So, as I already shared, SWP, STP also makes sense in this world of SIP. So, use these two great products for your advantage, because it makes a lot of sense in today's world. So, being rich is having money, being wealthy is having time. So make your investment journey in such a way where you are not spending too much of time in just making your investment happen. Rather, you should invest and then give time to your investment, which can create wealth for you in the longer run. So just to take you through some of the details of the Grow Mutual Fund. So we have Mr. Anupam Tiwari and Mr. Kaustav Sule, who are in the position of managing the funds for Grow Mutual Fund. Both have quite a rich history in mutual fund industry. They worked with Access Mutual Fund earlier, and now they are showing great performance with excellent research and their skills in Grow Mutual Fund. And here is some of the snapshot of their other schemes. Couple of schemes I've already shared with you. Just taking you through some of the other schemes of Grow. So Grow has this ELSS scheme. They have this mm, liquid fund, short-term duration fund, overnight fund, okay, or bond. So you have a good mix of debt and equity, and these are riskometers. Yep. Yeah. So before we get into the Q&A session, just would like to summarize it for all of you. Somebody who's starting and their investing journey and at a conflux where they want to understand what makes sense for them in terms of lump sum or SIP. So there is not a clear winner here. It purely depends on financial goals. But having said that, using the benefit of both in your portfolio, if you are allowed to do that and if you can do that, is nothing like that. So use lump sum when you have those big chunk of money coming to you in terms of bonuses. When you are selling some asset class, you have your fund availability, or whenever in your life when you have a larger chunk, you use lump sum investing followed with a STP kind of setup. Plus SIP, as I said, is quite effortless, no brainer. Use SIP and take advantage of averaging of pricing in long term. So mixing both the strategy in today's world makes sense. So we are almost done with our presentation, and I think Angelica, over to you. If we can take the questions from there itself. Yeah.
So this webinar was truly insightful, and I'm sure we've all learned something about SIPs versus lump sum and how it can be beneficial. Before we conclude, I'd like to open the floor for any questions from our audiences, and our speaker will be addressing them.
Mm, So I think there is a question where they're asking about the risk in lump sum and in SIP. So I think a couple of them I've already taken in my presentation, but if I may just go back and highlight some of them. In lump sum, the biggest risk is that you're trying to time the market. And as we have shown, somebody who had invested at the peak before the great financial crisis, even after spending 15, 16 years into markets, the returns are quite modest for him. Whereas somebody who had invested after the fall, so lump sum, you need to be very careful in terms of timing the market, and that responsibility is solely on you because you know when you want to enter. When it comes to SIP, the risk is more on the shorter end because as I showed you, for first few years, you need to be quite patient with your investment because there are times when you may not see any movement for almost about, let's say, 3 years, 4 years, 5 years also, because if the market is going through a let's say a troublesome patch, your SIP may not give you that ideal kind of potential return what you had expected. But that is the time when you need to be patient and you need to not stop your SIP but to continue at that time, because that is the fuel which you're adding to your fire, which will show result in the long run. So the risk in SIP is much lesser because you're putting tranches in a much smaller amount. So, but the only risk which I see is non-performance in shorter period, or I would not put it non-performance, but taking time to perform. I think that would be the right choice of word. Mm. Okay. Okay, so we are not taking any questions which are pointed to a fund. So I would like to refrain from that, Gaurav. Can't take up your question because I don't know your portfolio, so we'll not be in a great position to comment on that. But I think just to generalize, put up for you is if your portfolio is currently down and you want to do lump sum and continue to do SIP, take that decision purely from your risk and return profile, because how long market will take to bounce back it's nobody's guess, right? It's we don't know for sure, so you need to make sure that you should be ready to take that short-term volatility which lump sum brings with it. And if you're okay it, then I think in long run we all know that markets are pretty positive. because it has delivered that great returns in long term. So from that perspective, I think if you look, you can take that decision on your own. Okay. So XIRR and so there is a question on XIRR and a loss. So XIRR gives you the CAGR returns for the portfolio. Typically, you would have heard mutual fund giving compounded annualized growth rate in their fact sheet. But when you see into your portfolio, they show XIRR. So XIRR is a CAGR return for multiple investment done across multiple time over multiple securities. So when you are referring to a portfolio, you will refer it to a XIRR. When you are referring to one investment, you refer it with CAGR. So your coming to your portfolio, then the profitability and loss is depending on your purchase and selling price. So your loss or profit will solely depends on what is the price of per unit and what is the current value. So if your current value is higher than the average value, you are in profit and vice versa. Yeah. What should be the percentage allocation in small cap, large cap, mid cap, and flexi cap? Again, very personal question, because for everyone it depends on your age, your risk appetite, and what financial goal you are planning to invest for these products. For example, let's say if I am planning my investment for my retirement goal, I at my risk level I will not want a too high percentage into a small cap, because during my retirement I want to be sure that okay, there is not too much volatility in my portfolio. Probably in that case I may have a higher allocation towards large cap and let's say multi cap rather than mid cap and small cap. So it purely depends on a lot of factors, but having a diversified portfolio makes sense. And if your goal is a time bound goal, make sure that you are choosing products which are not too volatile in nature, because it's a time bound. Like child education is a time bound, retirement may be a time bound goal for you. Whereas goals which are like buying a car or going on a holiday, going on a track, which are not time bound, so there you can take a little bit of risk in terms of volatility, because you are not worried if the trip didn't happen this year, there's always a next time. So I think keeping that in mind, also your decision towards the choice of products can come in. Yeah. Any other questions and which you see?
No, but I would like to remind the audience that if you all have any more questions for the webinar, we would like to take them up and address them. And we're still open to comments.
Yeah. Okay. What is the expense ratio for MF investing? Okay. So expense ratio is a mutual fund bound thing. It is not dependent on the platform from which you are buying. So if you are buying a product from, let's say, any platform, the expense ratio will be dependent more on the mutual fund manager, and that is the charge which a fund house deducts from the investor's money on an annualized manner. So it gets deducted on a daily basis, but it's an annualized, it is shown in the annualized manner. And now, as per the SEBI rule, it has to be notified to all the investors. So you as an investor will be notified from the mutual fund company what's your expense ratio from time to time. Yeah. Yeah. I don't see any other questions. Yeah.
Yeah. Thank you, sir, for your insights on SIP versus lump sum. We surely found the session insightful, and I hope the audience found it as much as insightful as we did here. Your expertise and passion for the subject were evident throughout your talk, and we appreciate you taking your time to share insights with us. Thank you very much.
Thank you. Thank you so much for having me. Had a great time with all the questions around, and I hope this makes a lot of difference for our investor community. Thank you.
Thank you.